I'm Owen Bigland. This is the Inside Edge video blog. Okay, time for my comment mailbag here. I always like to use these ones from time to time. I'm not trying to poke fun at these people by any means. As I've said before here, sometimes I'll pull some of these comments I get here that I don't agree with whatsoever. They're flat out wrong. They don't want to listen to me, and that's fine. I always suggest maybe buy some investing books. Learn this stuff. Get out of your kind of cocoon here, or your blinders on about investing and buying real estate and holding it and long-term capital gains and those kind of things and the type of companies you buy. Some people you're just never going to reach. I like to point some of these guys out because I do not want you to be like these guys. You can learn from these guys. You can. And I'm going to use an example here. So I had a guy on my YouTube channel here, and I put something out on Twitter here. I always talk about, when you buy a piece of property in Vancouver, you got to have a long-term commitment to it. You could buy a home today, and next year it could drop 10%. No problem. Half of all the homes I bought, I talk about all the time, were worth less than what I paid for them at some period, usually in the first few years. After 8 to 10 years, I've never held a property, or a stock for that matter, that I wasn't up substantially on. But in the short term, anything can happen. You have to get that through your head. If you can't, you are doomed. You're doomed. You're not going to go anywhere. You're going to keep your money in a coffee can or a bank account, earning you zero and losing money to inflation every year. If you can't understand that simple investor mindset, then again, you have no hope for getting your money to work for you. And as I said, there's two parts of the equation when it comes to saving and retirement and creating wealth. A, the job that you're in or the career. You got to make money. You got to create the fuel, the dry powder, the cash to invest. And that's the other part. You've got to take that money and invest it, getting it working for you. If you're going to bury it in your backyard or put it under your mattress or in a coffee can or a bank account, which is the same thing, you are losing half that equation. But to get superior returns, there's going to be some short-term volatility and risk there with everything. Whether you're buying Apple or Home Depot or buying a good Vancouver home in Kitsilano or Oak Ridge, whatever you're buying. You've got to have a long-term commitment. So I put out a tweet here. Chipotle. I'm sure you guys are familiar with the Mexican fast casual restaurant Chipotle. So this is a guy that I follow on Twitter. He's a private equity guy. And basically it was, volatility is normal. Since the IPO, Chipotle went public in 2006. Since they went public in 2006, they have had a 10% pullback 21 times, 20% 6 times, 30% 4 times, 50% correction 3 times, a 60% correction 2 times, and a 75% correction once since their IPO. Total return, if you would have bought at the IPO and held it till today, 4,120%. The bottom line is volatility is normal. Now listen, Chipotle is an extreme example of this. I've got stocks, even Apple has had some tremendous up and downs. I'm probably up 15 to 20%, 2,000% on my early purchases of Apple. As a matter of fact, I did blogs about it back 10 years ago. But Chipotle since 2006, as I'm writing this now, in February of 2020, Chipotle was at $921 a share in February of 2020. So just before COVID hit. It fell in a matter of 4 weeks down to $560. Today, Chipotle, as I look today, is trading at $1,900 a share. So this is the ups and downs. So I had a guy in my YouTube channel here talking about, most people, not able to hold, when the markets drop 30 or 40%. And he's right. A lot of people panic and sell. You don't want to be those type of people. But he was basically saying that what I was calling, holding is called holding and hoping. You could lose up to 100% in that scenario. Plenty of stocks can go down 75% and never come back. What was high quality one year can be garbage the next year. Well, you're wrong on all counts there. Yes, anything can happen, but will Apple or Home Depot or Visa or the Canadian banks or Johnson & Johnson or Procter & Gamble or Pepsi go down 100% or even 75%? highly doubtful. Quality companies tend to stay as quality companies. As Warren Buffett would say, you want to buy a company that even a ham sandwich could run and still make tons of money. The companies I just listed are like that. Yes, you will get these broad market sell-offs. I've been through many of them. Back in 08, 09, back in the Black Wednesday or Black Tuesday back in the late 80s. In the 2008, 2009, I talk about it in my book, my portfolio was basically cut in half. It was a broad market sell-off. They threw the baby out with the bathwater. And in short order, those stocks recovered. We just had a tremendous pullback here 18 months ago, probably one of the sharpest I've ever seen, where the S&P dropped over 30% in a matter of about 4 or 5 weeks and quickly recovered just as quick. Those can be tremendous buying opportunities. If you have the right companies, this guy was saying that, a great stock this year is a garbage company next. Not if you're buying the proper companies. If you're buying AMC or GameStop or Rivian or one of these electric truck startups with no cash flows, no profits, nothing, they're losing money. You're buying them off of a hope and a dream. Yeah, those companies can easily go down and get wiped out 75 to 100%. But I'm not investing in those type of companies, and neither should you guys. The mentality that this guy had here, holding and hoping, that's not the strategy that I play, and you shouldn't either. And companies that are great today could be worthless next year. Highly unlikely to happen. It's that analogy I always use. You've lost before the game even begins. And the other blogs that I've done about people constantly living in fear. Always another dark cloud around the corner, and it just freezes them on the sidelines permanently. Next thing you know, they're renting, they're 60 years old, still in a rental, no money saved, nothing really net worth to speak of, because it's never been the right time to put their money to work. You have to understand that if you want the superior returns, there are going to be drawdowns along the way. It's par for the course. But if you've got the right companies, it should not bother you. As a matter of fact, if you like Macdonald's at $200 a share today and it goes down to $150, you should like Macdonald's even more at $150. But stop living in fear. You have to understand how investing works. And it's not a hope, a hold and hope. I don't invest in those type of companies. If you want to put a little bit of mad money into these highly speculative names, go ahead. But 90% or 95% of your portfolio should be in probably just low-fee index funds are the best thing for most people. And then high-quality, big blue-chip companies that I prefer ones that not only pay a dividend, but are what we call dividend aristocrats or dividend growers. They have a long track history of not only paying that dividend, but increasing that dividend every year. I like the companies that I own have incredibly, fantastic businesses, strong cash flows, free cash flows. They pay a handsome dividend. Wide competitive moats I always talk about. Nobody's going to come in and take market share from Apple these days. They're not. Nobody's going to come in and invent another Google or another Facebook. They're not going to penetrate Pepsi or Coca-Cola's market dominance. If they ever did come along with a soda or a drink that had promise, Coke or Pepsi are just going to buy them out. That's the whole game plan with another one of my favorite companies, Estee Lauder. Estee Lauder is an incredible company. I mean, if someone comes along with a good skincare product or whatever, and it gains some traction, Estee Lauder just comes along and buys you and bolts it on to the rest of their companies, and you get that marketing weight and their superior management, and end up increasing the sales 2 or 3-fold. Final thing I'll just say is thanks Justin. Justin Trudeau here. I hold all the big Canadian banks, well in excess of $500,000 I have in the Canadian banks. I'm always adding to it. We've had a nice run here coming out of COVID here on the Canadian banks. I mean, they got beaten up here last year. They've had a nice 6 months here. We're back trading at 52-week highs again. And then, of course, Justin, and being a socialist that he is, doesn't like anybody making too much money. And he thought the banks are making too much money, so announced that if elected again, re-elected, he's going to put a 2%, an additional 2% corporate tax on all the big banks and insurance companies, because they're just making obscenely too much money. And immediately now, as I speak, our TD is down about $6 or $7. Royal is off about $5 or $6. Listen, I tell you, we'll see where this goes. I haven't added to the banks recently, Canadian banks, but if it drops another $3 or $4 a share here, I probably will add some more to the banks, because, these banks, they still are under the COVID laws here. Last year, as you guys know, everyone thought that, everyone was going to foreclose on their house, and there was going to be a run on the bank, and the stock was going to go down to zero, and everyone was going to be living in the street. Turned out it wasn't the case. Real estate's taken a rocket ride up. These Canadian banks now are flush with cash, but the government won't let them increase the dividend. They haven't increased the dividend for almost 2 years now, and they will not allow them to buy back stock. The Canadian banks are sitting on a record amount of cash right now, and that is going to change. It's maybe later this year that they're going to lift that moratorium on dividend increases and buybacks, and when it does, that will be a nice jolt to the stock price on these banks. So, of course, you always get that knee-jerk reaction. When they announce that they're going to tax more to the banks, then you get a bit of a sell-off there. It's to be expected. But they're starting to look attractive again. You're going to see some buybacks here, and you're going to see some dividend increases. They are sitting on billions in cash right now. Canadian banks, it's a love-hate thing. I know why Justin Trudeau does it. They're an easy target. He's just buying votes with this. Everybody hates the banks. Even I have a love-hate relationship with them. The service is terrible. I had to make a call to TD or to Royal Bank Visa on my credit card for a chargeback, and just a total nightmare getting through to them. But I own all the Canadian banks because it's a monopoly or an oligopoly. They make fistloads of money. Everyone should own them. And just finally, so it looks good. Let's tax the big banks. And people fall for it. But people should realize something there. There was an article in Bloomberg here saying that, most Canadians own these banks and their retirement funds. People rely on these Canadian banks for their dividends. It's an orphan and widow stock. So he's just kind of, adding a 2% tax here and then reducing it and cutting your arm off over here. And remember too, I've said many times on this blog, taxing everything to death, it seems like a good idea. These big fat corporations will tax them more. But these tax increases from banks are going to come out of your pocket. If they have to pay more in taxes, they're just going to raise their fees, their overdraft charges, their credit card charges, their checking fees, their ATM charges. That 2% will be passed on to the consumer. It always does. But Justin, I tell you, it's the thing. Just tax everything. There's always a reaction to taxes. People need to remember that. But hey, Canadian banks, if they keep this little downfall here and keep sliding a little bit, pretty attractive. I think you're going to start again to see some nice dividend increases moving forward. Probably some buybacks here. They're flush with cash. I'm Owen Bigland. As always, have a good weekend. I'll see you next week.